Did you realize that the age pension is actually taxable? Now, a lot of people wouldn't think so because why would the government give it to you in one hand and then take it back with the other? Now, if the age pension is the only source of income that you have in retirement, you're not really going to have an issue because you're going to be below the taxable level of income once you factor in things like the senior and pensioners tax offset. However, if you have assets outside of the age pension that are producing income, then it could potentially become a problem. Or you could be on the opposite end of the spectrum where you have too much in assets where you're not even eligible for the age pension. So if you don't structure your assets correctly, well then you could potentially paying tax and not getting the age pension, which is not a good outcome in retirement. In this video, we are talking about smart strategies to minimize or eliminate tax in retirement using some asset structuring. The best way that you have to structure your assets in retirement and keep them away from the tax man is to use what's called an account-based pension. So this is the retirement phase of your superannuation. And if you want to learn a little bit more about how an account-based pension works, then I'll leave a link in the description below to our strategy library video, which explains it in detail. So in retirement, account-based pensions become your best friend. You can say goodbye to Susie and Nadine. You don't need them anymore. They can't offer you what an account-based pension can, because an account-based pension gives you a way to structure your investment assets in retirement 100% tax-free. So that's no tax on any income, no tax on any capital gains, and withdrawals are 100% tax-free as well. And the really incredible part, if you hold Australian shares in an account-based pension and those shares pay you a dividend and attach that dividend as a franking credit, that franking credit gets 100% rebated back into your account as additional income when you're in an account-based pension. It almost sounds illegal, wouldn't you agree, Bill? The catch is you are limited as to how much you can get into an account-based pension by contribution cap limits and the transfer balance cap. Let's start with contributions first. So there are two types of contributions you can make into your superannuation. You can do concessional contributions, which are your pre-tax contributions, or you can do non-concessional contributions, which are your post-tax contributions. Both of these have different cap limits. Now, there are some other different types of contributions you can make, such as a downsizer contribution or contributions made under the small business CGT concessions. But let's not overcomplicate things for now. We're focusing on concessional, non-concessional contributions, and if you need to know how they work in more detail, again, links in the description. In order to maximize the amount that you can get into superannuation and then subsequently transfer into an account-based pension, you need to be utilizing these cap limits efficiently. And you can think of it a little bit like pouring wine into a decanter, or if you're part of the younger crew, you can think about it like pouring beer into a funnel. You have to get that flow just right, otherwise you're gonna get booze everywhere. This means planning for your retirement is crucial because once you're no longer eligible to use those caps, well then it's tough luck. Once the money is in superannuation and assuming you meet the eligibility criteria to kick off an account-based pension, then the only other limit that you're gonna run into potentially is the transfer balance cap. The transfer balance cap is like the dam wall. We want all of our money to flow from accumulation phase into this account-based pension, but we're limited as to how much we can do by the transfer balance cap. So in the current 2024-25 financial year, the limit is 1.9 million. And next financial year, so from 1 July 2025, it's increasing to 2 million. So if you're a couple, you both have superannuation, you both have money in your super, you could potentially get $4 million into account-based pensions, which really is plenty. Again, links in the description as to how the transfer balance cap limit works in more detail. There is one more aspect to minimizing tax in retirement that I want to go over, and this one is one that a lot of people don't think about. And it comes at the point where you're transitioning those assets from your accumulation account into your pension account. In the ideal scenario, you would do what's called a seamless asset transfer. So what this means is you take the exact assets that you hold in accumulation phase and you in specie transfer them to an account-based pension. So the benefit of this is you don't incur any transaction costs, you don't have any time out of the market, and most importantly, you don't trigger capital gains tax. You don't want to be triggering capital gains tax or unnecessary capital gains tax in accumulation phase of superannuation, because that is your taxable phase of superannuation. Any capital gain that's made that's been held for longer than 12 months is going to get taxed at 10% in accumulation phase. So rather than do that, you take those assets, you transfer those assets into an account-based pension, and if you sell them down in pension phase, well, again, it's a 0% tax entity. So if you think about the power of that, we're probably going to be working what? The average person works 30, 40 years. That is a big amount of capital gains tax that you can accrue in accumulation phase, transfer to an account-based pension, sell down, and pay no capital gains tax. It's important to note here that not all superannuation funds, and in fact a lot of them, don't offer this seamless asset transfer. So if you're in, say, an industry superannuation fund and you're in one of the pre-mixed options, well, that's a pooled arrangement, and so you don't get access to the seamless asset transfer under a pooled arrangement. Some funds do offer what's called a retirement bonus, which is basically like a one-off payment to help compensate for some of the tax benefit, but even still, a lot of funds don't even offer that. So you really want to be careful about what fund you're in. So if you're looking for seamless asset transfers, you generally need to be in something like a wrap platform or a self-managed super fund, or one of the more member-directed options. I previously did a video about the retirement bonus, and again, I'll link that in the description box below. So there you have it, the key things that you need to consider about minimizing tax in retirement. Now, if you can't get all your money into superannuation, or you plan on retiring before you meet preservation age to access superannuation, then there are definitely things that you can do outside of superannuation. However, I think we'll save that for another day.